Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. So a really nice week for us last week. Of course, the market did very, very well. We monetized winners in Uber, Hood, MSTR, CALH, actually, a name that's really been suffering for a long time, but sort of bounced back recently, along with Monster. Some energy drinks are doing well. Meta, Amazon, Reddit, and Costco trades are kind of sitting pretty there. Reddit, I love that stock and the chart, but with earnings approaching, I think it's maybe time to just take this little short-term win. It should be about 35%. Markets are fairly stable this morning. At 90 bucks on it, I'm happy to hold. I think it's been crushed too much. At 120, I'm going to ring the bell here. I'm still long a little bit of stock. So in addition, sold some Netflix calls to lock in 1030 on a leaps trade. So that makes it a 50% win on those leaps that I bought just about a month ago. So I've been mentioning on a few shows that we're going to continue to see an unwind.
Hey everyone, if you haven't subscribed to the channel, please do, and be sure to download my free Options Cash Flow Blueprint, a step-by-step guide for how to go from complete beginner to options ninja. Now back to the video.
Of extreme bearishness, levels that we haven't really witnessed for quite a long time, since the global financial crisis in some ways. If you look at those daily S&P ranges, they were at GFC extremes. That AAII sentiment readings, lots of sentiment readings, very, very, very bearish. COVID lows, bearish. Everyone just overly negative. And Trump, of course, we had the flinch, we had the bond put that came in when things started to break a little bit. And then, of course, just little flinches along the ways. And so what that does is it suggests that there's less of a bull in a China shop approach. That's really, really big, right? We were sort of at this stage around 4,900 where it felt like he was going to drive the economy off a cliff, the global economy, really. And so that's a little bit off the table. That has really pulled us back from around VIX of high 50s down into the mid 20s. And because things just looked very bleak, right? Big tariff numbers, 145% China tariffs, refusing to engage. So things looked very dire. And so at least a lot of that dread that was palpable has been dialed back a lot, right? So, but having said that, we're going to talk about some things today. The damage is still being done out there. It's real. It's not going unnoticed by certain measures. My risk gauges in the room, even outside of the MTI, are at very elevated levels. We look at the 10-year yield, lots of stress. VIX futures curve, I'll show you that in a moment. Very stressed, even after a 600 to 700 point rally. I think that's quite notable. We've gotten back about half of what the S&P lost at its lows, and the VIX futures curve is still very, very nervous out there. The US dollar hasn't exactly taken off on this better sentiment and these Trump flinches. And we've seen some credit spreads. They're still pretty wide. They've kind of dialed back a little bit lately. So economically, things haven't been super bad, you could say, because of this full pull forward purchases ahead of the tariffs, right? So if we look at inventories, of course, everyone's kind of buying to get ahead of those tariff price increases. So they're really loading up. So that's gonna turn into decent numbers in the short term. So I think the numbers are very skewed right now. They're not very indicative of what's really going on out there. So we have to be very, very careful. So we'll talk about the downward revisions that are just starting to pick up in a moment. So let's talk about some big headlines this week. A lot of economic data, jam-packed really. So, the headliners are going to be that first quarter GDP, March personal income expenditures, April's payroll employment. So we're expecting basically some fairly strong data, right? So I don't think anyone's expecting numbers to really drive off a cliff here. But remember, we're talking about that pull forward. We're talking about this tariff drama being relatively new. And so we have to keep that in mind, that there's going to be a little bit of a lag effect with all this stuff, especially with that pull forward demand. I'll show you that in a moment. So let's take a look here. Wholesalers, retailers really rushing to build those inventories ahead of the tariff implementation. So look at that surge in imports. Consumer spending growth was maybe a little bit subdued because of the January and February cold month effect. But that's going to give us, relatively okay GDP. And the thing is, everyone's kind of looking to Powell, please cut rates. But really, unless he sees the data right in front of him, he's not that much of a prognosticator, right? They tend to wait for the data to really compel them to do something. And they're not going to see it. I really don't think they're going to see it unless it's absolutely disastrous. I'm really a little skeptical of that. Personal income and spending. So we're expecting solid increases, personal income, consumer spending for March. It is what it is, right? For now, people have taken a little bit of a hit in their wealth effect, but I don't think it changes all that much. There's some negative sentiment out there, but right now, Americans can spend and they still are doing so, but that could end very, very quickly considering some of the sentiment that I've been showing you guys in various videos. So private wages and salaries probably rose to record highs. And of course, people just buying a lot of big ticket items ahead of these tariffs. Employment payroll number coming up. So employment rose 228,000 in March to a new record high. April's gain is probably going to be a little bit lower, maybe around 150,000. Unemployment claims, initial unemployment claims, relatively low. So we'll probably see those at near historical lows throughout this month. Challenger announced private sector layoffs, also showing very little cause for worry so far. So in some ways, not much to see here, right? That's good. Now, inflation, March's PCE headline, core inflation, we're going to see that on Wednesday. That should be pretty low on a month-to-month basis, maybe 0.1%, according to the Fed's inflation nowcasting, right? You can kind of go to the Fed, look up Fed inflation nowcasting. That's going to give you a little idea of what's going on. And so that would put these around 2.2%, 2.5%, down a little bit from their February readings. That's a very positive thing, right? So that's going to confirm to Powell that not too much to worry about on the tariff front. On the growth front, on the employment front, those are kind of on the watch list for him. Now, so that's kind of the good. I like to always do a little bit of the good, the bad, and the maybe. So that's kind of some of the good, but let's look at the bad. So sharpest earnings outlook decline since 2020. So look at this, falling off a cliff. Now, remains to be seen how much of this is a level of paralysis, right? So I've kind of floated this idea at my show with Samantha and just sort of said, listen, I floated this idea that maybe, there's a little bit of kind of everyone freezing up a little bit because of the very sudden and chaotic 180-degree turn from the administration, which has really put the world in turmoil, right? So there's a certain amount of just kind of people freezing up, not necessarily being financially restricted, but just kind of holding back and going, okay, maybe I'm just going to wait on booking that vacation kind of thing. So, just a little bit of worry out there, and CEOs are certainly going to play a little bit of a game with Trump as well, just saying, hey, look at this is going to be awful. Look what you're doing to everyone. This isn't right. So we'll see how much of that happens as well. So there's going to be a little bit of theater out there. And certainly you can see this right here, consumers very worried about losing their jobs. So this is soaring almost to GFC levels. This is very, very notable, right? So this worry eventually works its way in. People have a little tendency to kind of stick their head in the sand, keep spending a little bit, and kind of hoping that things get better. The longer the tariff drama goes on for, the more damage it inflicts, the more this is really going to matter. So we definitely have to keep that in mind. Here's something, this may speak to perhaps some lower income folks, which maybe aren't always as important to the stock market, but share of credit card accounts only making a minimum payment rising well past the levels of COVID. Very, very notable. This is going back many, many years, at least 12, 15 years. And CEO confidence, of course, coming down. Again, I think there's going to be maybe a little bit of theater here, but definitely an issue. Let's look at our risk gauges. So we see the credit spread index kind of coming in a little bit, right? Very, very concerned here. This is going to help to pull that VIX back, right? When this is soaring, the VIX is going to absorb some of that, and this is pulling back. That's a very good sign. What's not a good sign is that the VIX futures curve is still very much in a very alarmed state, right? We have inversion, backwardation, all the way down as we go out on the futures. A more healthy look would be starting low and going higher and higher and higher and higher. We've got the VIX above the VIX futures here, right? So we have this positive gravity that's difficult for stocks, for names like SPIX, SPXY. This is still playing into VXX and names like that. That could change very, very quickly with a Vega reset, and one tweet. But it is what it is, so we need to be aware of what's going on out there. So hopefully that gives you a little view of what's going on out there. The coast is definitely not clear, even though we've had a significant rally in the S&P. We are doing things that are going to take advantage of perhaps a little bit of toppiness here. Let's take a quick look at the S&P. So we've got a market that really got crushed, almost 20%. And then we've had a very, very nice rally back. What I like to see is that some of these moving averages are starting to turn up a little bit. That's a very short-term 9 EMA. That's typically where I might get a little bit bearish. As you see, we can see that as we get to that 9 and 20, we generally pull back in a bearish kind of environment. Pull back, pull back, pull back. So all those times. Now we're kind of pushing through here. So I want to be a little bit careful. I don't want to get super, super bearish. This could be turning into a buy the dip kind of environment, right? As these things start to recycle, we can see our ATR coming down from exceptionally high levels, which makes sense. We had some of the largest moves we've seen in 15 plus years. So that's maybe not at all that surprising, but it's a good thing to see, right? We want that realized volatility to start to come down. That's going to compel some of the CTA, some of the vol targeting funds, which have been delevered down to almost zero in some cases. That compels them to start buying. We can see some of the CTA vol targeting levels basically buys in a slightly down, slightly up, or neutral market. That's very, very positive. Whereas synthetic gamma from ETFs and things like that were really helping to push things down, which I talked about all the way down. I said, this stuff is pushing the boulder down the hill even faster, right? Like we needed that, but that's basically what happens with this incredible amount of AUM in that leveraged in inverse world. Right, so we had a nice little bounce back. Of course, everybody's looking at this spot because 5,500 seems like 550 on the SPY. It really seems like a spot to pause here. What is the pain point? Well, probably the pain point is probably just maybe up a little bit higher, just to kind of shake out a few more shorts as we get up towards this 50-day moving average, which has now crossed below the 200-day, right? So this is that death cross you want to keep an eye on. This is not a picture of health. So I think until further notice, this is probably going to be range bound. Maybe we kind of head down towards 500 again, but I don't think we get a whole lot higher because this market's starting to get very, very expensive on a fundamental basis. Can we put a lot of faith in fundamentals? Well, no, we can't, because when things get crazy, we get crazy moves, right? So there's no question we could rally up a little bit higher here. I certainly wouldn't be sticking my neck out until I see a little bit more consolidation that leads me to believe that we're really kind of topping out here. And that as we continue to see those earnings revisions move downwards, there's just going to be more and more negative news. One thing I'm going to be watching is that foreign money. A ton of it has left the U.S. market. Does that start to stabilize? That could be positive. And I think they're making a mistake in the long run. I think that some of that money is going to have to come right back in again at some point. So there are many, many positives and negatives. For now, I feel like the upside is quite limited. I'm probably going to be looking at some credit spreads to take advantage of generally what is still kind of high vol, but not really. It's not super, super high. So it's a bit more technical from an edge standpoint. But at a 25 VIX, things aren't super, super expensive at this point. So I'm going to watch, I'm going to monitor for this action, look for little pullbacks to maybe into that 9 EMA now, see if that holds, right? So what was resistance now maybe becomes support. So if we start to get some support in here, that could be an interesting time to probably maybe do a little put selling, maybe a little credit spreads, probably given where vol levels are. Do some credit spreads to take advantage of this high volatility. But right now, we've kind of pushed up into that pain point, which is the bearish side of things, right? The bears are very confused. How can this be happening? And so I talked about that last Wednesday. I said with Brent Kochuba on the show, I said, listen, I think we could still get a little unwind of this incredibly high level of bearishness. And that's exactly what's happened. We've just kind of pushed up and up and up and up. So hopefully you guys enjoyed that, and we'll see you in the next one.